Hey family, welcome back to Imani Invests. I want you to take a trip down memory lane with me for a second. Picture yourself at 24 years old. Maybe you're resplitting a cramped two-bedroom apartment in a city like Denver or Atlanta with a college roommate. You just landed your first real job making $1,000 a year. After 4 years of library nights and dining hall pasta and carrying a diploma that cost you $30,000 in student loans, you finally feel like you've crossed the finish line. That first direct deposit hits on a Friday, and you check your bank app 7 times before 5 p.m. just to see the number. Something in your chest loosens. You made it. You tell yourself you'll start saving next month after you buy a real bed frame, after that first student loan payment clears, after you get settled. But next month turns into next year, and suddenly you re-30, and next month still hasn't arrived. Or maybe you in your late 30s now. You bought the house you were supposed to buy, but between the mortgage, property taxes, the HOA fee, and the daycare bill for your 2-year-old, your checking account has become a revolving door. Money enters, money exits, and nothing stays. Your parents talk about building equity, but they didn't. To mention that equity to buy groceries in retirement if your 401k has been stuck at $19,000 for 3 years. By the time you hit your 50s or 60s, that hazy concept of someday becomes a cold, hard deadline, and the numbers on your statement make your stomach drop. Here's the truth nobody explains. Every single decade of your financial life has a specific trap built into it. These are predictable, documented patterns that catch millions of us at the same age, for the same reasons. These traps don't care how hard you work or how good your intentions are. They are woven into the very fabric of American life, into the student loan industry, the mortgage market, and a retirement system that profits off your confusion. These traps will consume your wealth silently unless you see them coming. Today, we are breaking them down, decade by decade, so you can build an escape plan. Whether you are 22 or 62, you are sitting inside one of these traps right now. Let us find your way out. In your 20s, the trap is delay disguised as logic. The most expensive sentence in your 20s is, I'll start when I make more money. It sounds so reasonable. You look at your check, subtract the rent and the loans, and the $30 or $80 left over feels too small to matter. This is what we call the income threshold fallacy, and it is the most destructive belief you can have. If you invest just $200 a month starting at 22, by age 65, you're relooking at roughly $879,000. But if you wait just 10 years until you re-32, to start that same habit, you end up with only $375,000. That 10-year delay just cost you $500,000. You didn't invest less, you just ran out of time. I think about 2 roommates, Terrence and Ava, same school, same starting salary. Terrence decided to wait until he got his first big promotion at 25 to start saving. But when the raise came, his lifestyle expanded to match it. Nicer car, better apartment, and he still felt like he couldn't afford to save. Ava, on the other hand, enrolled in her 401k. Her very first week, she never felt the money because she never had it in her check. By age 30, Ava had 3 times the retirement balance of Terrence. She didn't have a secret, she just had a head start. In your 20s, your greatest asset isn't your salary. It's your time. Don't let the lifestyle establishment trap set a spending floor so high that you can build a gap. Keep your rent low, drive a reliable used car, and automate your future before you even see the money. When you hit your 30s, the trap shifts to the housing decision. This is the most expensive mistake most Americans make. It starts at a barbecue where a friend shows off their new quartz kitchen island, or your parents ask when you're going to stop throwing money away on rent. The pressure is about identity, not math. The bank might approve you for a $400,000 mortgage, but they use a debt-to-income ratio that would make a monk go broke. If your housing, taxes, and insurance eat up 50% of your take-home pay, your investable gap collapses. When the gap disappears, wealth building stops. You become a hostage to a house. I've seen people raid their retirement accounts just to fund a down payment, trading $170,000 of future wealth for $17,000 of present equity. That is a 10-to-1 trade against your future self. The escape here is a hard rule. Keep your total housing cost below 28% of your gross income. If you have to rent for 3 more years to save a real down payment without touching your 401k, do it. Those 3 years will pay for themselves 10 times over. And please stop treating credit card debt as normal. In your 30s, debt normalization is a wealth emergency. A 22% interest rate is financial cancer. Attack it like your life depends on it, because your freedom actually does. In your 40s, you hit the squeeze. This is the sandwich generation trap. You re-earning your peak salary, but your teenagers need college funds and your aging parents need care. You are being pressed from both sides. The biggest mistake here is rating your retirement to pay for your child's college. Sis, let me be real with you. Your child can borrow for college, but you cannot borrow for retirement. There is no retirement loan. Diverting your 401k contributions to a tuition bill for 8 years can cost you over $600,000 by the time you retire. The truly loving thing to do is to secure your own financial mask first, so you don't become a burden on your children later. Talk to your parents now about their long-term care plans before a crisis hits. In your 40s, you have to play triage. Retirement comes first. Everything else fits into what's left. By the time you reach your 50s, the trap becomes the panic catch. Up, you open your statement, realize you reach short of your goal, and the panic sets in. This leads to 2 dangerous paths: risk escalation, where you gamble on crypto or hot stocks to close the gap, or paralysis, where you give up entirely. Both are a mistake. Your 50s are actually your most powerful wealth building window, because your base is larger. If you have $250,000 saved at 50 and you max out your catch-up contributions, you can grow that pile to $1.5 million by age 65. Your 50s are the decade to press the accelerator, not to gamble or coast. This is also the time to get ruthlessly honest about your debt. Entering retirement with a paid-off house and 0 car payments is a superpower that makes a modest portfolio feel like a fortune. Finally, in your 60s, the trap is the Social Security miscalculation. This is the single biggest decision with the least amount of education. You retired, your body aches, and you want to claim your benefits at 62. But claiming at 62 means a permanent 30% cut in your check for the rest of your life. If you wait until 70, that same benefit grows by 77% compared to the 62-year-old amount. That could be a difference of over $1,000 a month, every single month for life. Don't make this decision based on a conversation at a barbecue. Build a bridge strategy, work part-time, or draw a little from your savings to let that Social Security check grow. It is the best, guaranteed return you will ever find. Across all 5 decades, the theme is the same. The culture tells you one thing, but the math says another. The culture says delay, buy the big house, fund the kids' college, and take the money now. The math says start early, protect the gap, triage your priorities, and be patient. These traps only work in the dark. Once you turn on the flashlight of financial literacy, they lose their power. You don't need a high income to win, you just need to understand the rules of the game. Whether you are 24 or 64, the math starts working for you the moment you decide to use it. Money isn't too complicated, it's just about being intentional. You've got the knowledge now. Family, let's get to work and build that legacy. Hit that like button and subscribe to Imani Invests if you are ready to escape the traps. I'll see you in the next one.